Bitcoin only cause I got that mad cheddar. Bitches and Bitcoin go so good together. Make it rain with Bitcoin cause I like it way better.
Hi guys, good evening. This is Shaibu Mama and welcome to Crypto Mama's channel. Today we are actually diving deep into market structure and we'll be studying one particular pattern, and that is the M pattern. So the M pattern is basically a well-known trading pattern, but it is very underrated, though it has a very strong completion rate. This particular pattern is one of my strategies that I use to trade. I am going to show you how I trade the M pattern and the types of M pattern I look for, and how I trade it in a bullish market, as well as how I trade it in a bearish market. So let's get straight into the tutorial right now. So first we have the type 1 pattern. That's the type 1M. And with the type 1M is basically the normal M structure we are all familiar with. And with this M, when you see it form in price action, but before you can be able to trade this M, you have to train your eyes how to do what? To always recognize the M, because it's not going to be clear written like how you do it in your books or how it is clearly written here. There's going to be a little variations here and there, so you have to train your eyes how to see it. And how you do it is that you go back into your chart, look around, trying to spot the M's. That is why I have listed all the 4 types that you will find in the chart right here. So let's continue with our discussion. The first one is the type 1. So with the type 1 is the normal M that you actually expect to see. It's very basic and it's clear to see. So with the type 1, when you see it form, you always expect, that is 90% of the time, this is going to happen. You can back test it and come back and give me your feedback. I can prove this that 90% of the time this is going to get completed. So when this pattern form, you expect the market to do what? To trade back to this level, at least trade back to this level. And we have the type 2. The type 2 is the one that has a protruding swing or a higher swing than the previous what swing. And with this one too, you expect it to do what? To complete at the neckline. And we have the type 3. The type 3 is the one that has a failure swing. That is the one that creates a lower high. And with this type of M, you also expect it to complete at the neckline around here. And we have the type 4, which is different from the other 3 categories. And with the type 4, we expect the first completion zone to be here, and the second completion zone should be here. So this one is a bit complicated. And with the type 4, you can see the type 4 in 3 folds. It can come in the form of the normal M with the tops equal, or it can come in the form of the type 3 with the failure swing, or it can also come in the form of the type 2 with a protruding swing. So let's go to how you can trade the M pattern. All right, now that we know the M formations and the 4 ways they appear on the chart, let's now look at how to apply it to trading a bullish market, and as well as how to apply it to trading a bearish market. So in a bullish market, you expect what? The market to be making higher highs and higher lows. And at a point, you will see the M getting what? Getting formed. And at where the M is formed, in a bullish market, when the M is formed, your point of interest is around this area here. This area. You want to be targeting the low of this the low here. So your point of interest is around this area. You see, when the market is bullish, you see this leg coming down. You will see it to be what? A bearish market. So around this area, you will be waiting to see that the market will realign with the prevailing external structure. That is the internal structure come down here. That would look like a bearish trend. You expect that it will realign to look like something like this. When the market is coming down, you see in a bearish, when you go to your lower time frame, it will look like something like this, like a bearish trend. But at a point when it reaches here, you then see it shifting. So this is where you expect the market to do what? To shift structure. Then you take your trade to the upside. And in a bullish market condition, how you take the trade is that you don't expect the market to stop here and make a low. Nope. You don't expect that. You either expect the market to stop here, come back to your entry level and go higher, or you expect the market to either break, retest a little, and go straight higher. So when the market is bullish and you see the M pattern forms, you don't expect it to do what? To start here and trade lower. Expect it to break the structure and trade higher. So now let's now go to the bearish condition. And in a bearish market, the market is doing what? Making what? Lower lows and lower highs. And at a point, you will see the M structure coming into play. And when the M structure develops and the overall market trend is bearish, your point of interest is the neckline. The neckline is where you want to be trading. You want to be taking your trade from. Why? Because in a bearish market, you expect the market to stop at the neckline and make a low. If the market should break above the neckline, it means that structure is doing what? Is shifting. And since the order flow and the overall trend is bearish, you don't expect it to break the neckline. It should start here and trade lower. So whilst in a bullish condition, your point of interest is the low of the M. In a bearish condition, your point of interest is the neck of the M. So take note of these two areas. This is how you trade an information in a bullish market and an information in a bearish market. First, we will be learning how to apply the information in a bearish market, and we'll be using GBPUSD for this explanation or demonstration. So as you can see, GBPUSD has been trading down for several months now. So let's look at how we can apply it in a bearish scenario as we have seen in GBP USD. So let me zoom out the chart. All right, so when I zoom out the chart, you can see an M here. You can see an M here. And after the M is formed, where is the neckline? The neckline is around here. And you see the market did what? The market traded to around that level, stop there before doing what? Making a lower low. That is the first example. Let's find another example again. This particular leg here, you see an M again. 1, 2, 3, 4. And this one comes in a form of the overextended M. And after creating that M, the market traded to the neckline again. See, this is the neckline. The market did what? Ran above the neckline to this what? Order block. But in all, the market stopped around the neckline. So this is the whole area you should be your point of interest. So when the market came around here, you will see that it wouldn't have shifted bearish before going to the other block. It's after going to the other block it will shift bearish. So you will still be able to get into a trade if you had patience to wait. And after that, the market melted down. So let's find another example. Another example is this one here too. It's also an M. You see? You see? It's an M, an overextended one. And after it was created, the market did what? Traded to where? The neckline exactly. And what? Melted down. You see? It melted down and created a new low. Let's go again. See here again. We have an M. 1, 2, 3, 4. And it did what? It came here and fell short a little. Fell short a little and pushed down, created a new low. Let's go again. We have an M again. Here is it. Here is the M. You see? The whole hole here is the M. See, it's a very long overextended M. And at this point, you expect the market to do two things. The first one we said is that the first what is here. When we have an overextension, the first one is here and the second is here. So on GBPUSD, you expect the market to trade up to this zone here before even making a new lower low. So these are some of the examples we can find on GBPUSD on how to trade the M pattern in a bearish market condition. Let's now look at how to trade the same M pattern in a bullish market condition. And with this example, we'll be using USD JPY because it is the pair that is currently in a bullish market. This is our USD JPY chart, and we'll be using this one to demonstrate how you can apply the M pattern in a bullish market condition, because you can see the USD JPY pair is currently in a long-term bullish market. So we'll be looking what we will check. We will go into the chart hunting for M patterns and how we can trade them. So let's zoom out the chart and we see some of the M pattern that we have. Okay, we have one here. This is an M pattern here. You see it here. And I told you what, in a bullish condition, your point of interest is around here. This is where you expect to take your trade, not at the neckline, because you expect it to do what? To break the neckline. And this is where you will be looking for what? Shift in market structure aligning with the underlying trend or the long-term trend. So the market did what? Actually broke the neckline, created a high, came back and retested the neckline here before flying. Let's hunt for another example. All right, we have another example here. Here is an M. And same vein, this should be what? Your point of interest. Why? Because you expect the market to do what? To break the neckline. Why do you expect the market to break the neckline? Because the underlying trend is bullish. Simple as binary. It's either A or B. You see, the market broke it. You can even see it here. The market broke it around here. The market broke it around here. It tested with this small breaker block. This tested with this small breaker block. And the market did what? When it retested with this small breaker block, the market went back to do what? To make a higher high and came back to that block. You see, the market came back to that same neckline region and before what? Making another run to the upside. And we can see another M here. That one is not completed yet, but I'm going to use it as a demonstration, just like how on GBP, JPY, we saw the M pattern that has not been mitigated at the neckline yet. It's here. So here, what we are basically going to do is that one, this is your point of interest. So this is where you will be waiting for a market in something like one hour or 4 hours. And when the market gets here, this is where you want to go to your lower time frames, waiting for the market to shift from a bearish market as it will be coming down to a bullish market before you take your entry. So this is how you trade the M and this is how you trade the M pattern in a bullish and as well as in a bearish market condition. So thank you for watching this video and I'll see you again in another video. But don't forget to subscribe and like the video if you like the content you have just watched. Thank you.